Hello everyone, I'm thrilled to welcome you all to this empowering webinar by Yes Securities Investor Shala in celebration of the World Investor Week. This week is a global initiative that emphasizes investor awareness, education, and protection, a cause that holds immense significance in today's rapidly evolving financial landscape. As we know, India is projected to become the world's third largest economy by 2027, in fact, overtaking Japan and Germany. It is also expected that India's GDP will more than double from $3.5 trillion to over $7.5 trillion by 2023. So what are the three principal stacks that are playing out for India? The first one being the manufacturing hub. We have having the led by the opening up of the FDI investments, the corporate taxes have come down, and there has been a significant investment in infrastructure. The second is the India stack, which is really the revolutionizing of the payment industry and the healthcare sector. And lastly is the rising energy consumption, particularly in context of the global strategies and transition. Additionally, we are also poised to be the third largest stock market globally within a decade. And our Bombay Stock Exchange is expected to reach 10 trillion in market capitalization. So the question really is, are we ready for this exciting journey? And with us today, we have Anshul Arzare, a luminary in the Indian capital market and financial services industry. He brings forth 2 decades of valuable experience and has been a very key player in Yes Securities. In fact, in 2022, he assumed the role of a joint managing director and a chief executive officer, steering the company to greater heights. Anshul's expertise in crafting growth strategies, enhancing brand equity, and elevating customer experience. Welcome, Anshul. It's great having you here today.
Hi, good evening all.
So may we start with the first question, Anshul. My first question to you really is, how are you reading the current economic growth trajectory of India? Recent IMF has revised India's growth projections upward. What does this mean for FIIs, DIIs, flow in the Indian equities?
Globally the projections for India on the growth side is around 6.1%, right? But you actually look at our domestic calculations, it is way above 6.4%. That is the growth in GDP we are expecting over a period of 1 to 2 years from here now. And if you actually look at globally, that percentage is on an average 3%. And for emerging economies, India is one of the leading players on that side. And for other emerging markets, the average is around 4.5%. So if you look at from that perspective, India will remain one of the most strongest economies to bank on as far as an investment is concerned. So we feel that on backdrop of the strong growth and the China plus one strategy also playing its key role in terms of an alternate manufacturing hub for various components industry, and looking at our geographical positioning as far as the location is concerned, and the peninsula which we have, with the coastline which we have, with the kind of imports we have to for the global movement of the parts or components or products and goods. I think we are poised to be one of the strongest in terms of attracting any sort of FDIs and FIIs, because ultimately anywhere for an investment, it follows a return. And in India, if you look at it from all those perspectives, and a very, very stable government at this point of time, and very, very strong reforms which we have taken over a period of last 10 to 15 years, I think we are one of the best suited locations for any foreign money to come in.
Right. Thank you, Anshul. That's very, very interesting. My second question to you, Anshul, is the geopolitical factors can have a significant impact on investments. While it is difficult to predict geopolitical trends, how do you think an investor can protect his or her portfolio from such trends?
It's very, very difficult and near impossible to predict any geopolitical trend so early. I know
Right.
it's very, very difficult. We never envisaged what kind of a pandemic situation we all will envisage, and we could never understand that, and it will never be easy to
Mm.
understand that, and it will never be easy to predict any kind of an disruptive global event.
Right.
Too early, way too early. It's very difficult. But at the same time, how we can play around with it is the key word out here would be diversification, and not only diversification across geographies, it can be diversification across sectors
Right.
and within the geography, outside the geography, and the one of the other biggest vector which plays a big role out here to trade way through any of the geopolitical events is being invested into commodities, which is
Right.
because these commodities are very, very specifically, if I say, they are the most safest in heavens when we talk about gold and a silver, because
Right.
any untoward event when they happen, when you see the prices rise, what kind of price rise happens in gold and silver, that gives you a stability to your portfolio. So diversification across geographies, diversification towards resilient economies, which are much more conveniently paved to trade into these difficult situations, and obviously diversification into commodities like gold and silver. I think these are the couple of vectors where you can navigate through difficult global situations at some point of time.
Anshul, linked to that, I have a question, which is, there is this growing popularity for EVs, right? And how should investors position themselves to take advantage of such growth sectors as well?
Yeah, so the interesting. So as we see, what happened to IT industry
Right.
around 20 years back is it was a complete shift which happened to the IT industry.
Right.
But at the same time, not all of the players which came into the market at that point of time are as sustainable as we see very few of them today, which is like Infosys or a Wipro or a similar companies like HCL Tech and all, So EV space is into that zone at this point of time. A lot of companies are emerging into that segment, and we need to be very careful about that. Which company from here can actually make it big? But the important question out here also is EV has two parts. One is the manufacturing of the vehicles, and one is the component manufacturing. So manufacturing of the vehicles, we see that currently the adaptation is way too higher in a two-wheeler and three-wheeler segment as compared to a four-wheeler segment or trucks or tractors and all that, which is commercial vehicles. So if you look at a penetration on two-wheeler segment, it's close to around 6% at this point of time. For a three-wheeler segment, it's around 18%. If you take care of the e-rickshaws, which are unregistered vehicles, so that's around 40-45%. So in that segment, I think a lot of manufacturers who are playing a role in that would be definitely strong contenders to hold on to those stocks for a future benefits. At the same time, the adaptation in the four-wheeler segment, which is passenger vehicle four-wheeler, is little slow. It's around 1.3, 1.4% at this point of time. But the another large player, large product, which is the EV buses, that will
Right.
adopt it more faster. Now, coming to the component industry, when we look at the old industry of auto, which is IC, internal combustion engine, it is filled with a lot of parts. The combustion engine per se has so many parts, and that component industry is close to $5.6 billion industry at this point of time, as compared to overall industry of, I guess, around 10 to $11 billion. So half of this is of the component industry. When you look at an IC engine, it has like piston blocks, crankshaft, camshaft, radiator, cooling systems, and oil movement systems and all that. So if when you look at from that perspective, there is a lesser component in EV, but yes, there are many components further in the EV segment as well.
Right.
So a lot of companies who are into EV component space are also can be very, very attractive at this point of time, because they will also play a as huge role as the other component industry played when the development of automobiles happens in across the world. So that way, these are the two factors which we should be privy of as far as EV is concerned. At the same time, the ancillaries to this, which is who provides the raw material for this entire build-up, is also you can look at it. So mining and minerals is something which will be play a big role as far as production of batteries and all that are concerned, the chemicals which are used in production of the batteries, the metals which are used. And the second way to look at it is power distribution.
Right.
because ultimately that will be needed to recharge these batteries, and that would also play a big role in as the EV space develops.
And Anshul, just taking that further on the power station perspective, do you think that the adoption in this country is going to be largely actually be more dependent on the power consumption, and therefore it might be slower than what is the whole euphoria about?
So
Or
right
you
now,
think
if
otherwise?
no, it'll so everything will follow. One will follow the other.
Okay.
So as we see a strong growth in purchase of EV vehicles,
Right.
the power distribution will follow.
Right.
And as we see today, the kind of an capabilities which we have, I think we are. The growth will not take too much time to come to the terms of the product sale and distribution.
Right. The other question, Anshul, that I have is that there is a whole lot of cry around AI. And, everybody is talking about AI. What do you think are the investment opportunities there? And how should an investor navigate really, in picking up, given the fact that the AI is really transforming across the board? So one, there is conversation, and yet there is a lot more that is beyond conversation as well. So where do you think should one as an investor look into?
Absolutely. So as I said, similar to what fundamental you should to use when you are investing into commodity EV is what is the similar logic you have to build put in when you are investing into any companies which is into this AI.
Right.
So as I said, the enabler to AI is the chip. So as we come into the AI activity, which is really addressing or in terms of how should I say, like on a very basic level, what does an AI do? It uses a lot of data and gives you an answer, a summary of that to that's called generative, right? So it generates the answers itself. But to generate the answer itself, it has to process a lot of data in a very high speed. So what do you need for that? So you need a stronger processors. So that industry would really, they are on the hindsight, but that industry is also have to be looked at. So today, in earlier terms, we have CPU, central processing unit in computers, right? Today, it has been replaced by GPUs, which is graphic processing units, because the speed of processing has to be really high. So we have to look at that, which are the industries which are involved in generating these chips, because when the technology develops, to use the technology, you need these chips. High processing data you need. At the same time, I mean, how many of us really know what is the full form of GPT? Are you aware?
Yeah.
No? GPT, what is the full form?
Generative. Oh, wait.
Yeah, so it is,
I knew this.
yes.
But
So,
it's just
so it's
not
a
coming to me
generative pre-trained transformers.
Correct.
You know,
Pre-trained transformers.
so this is a technology actually, so which helps you to come out with, so process a large data,
Right.
which we call it LLM, large language modules.
Large language model.
Yeah, so that kind of a level of data you have to process in a shortest possible time, and then that application comes into picture. So a lot of companies already have taken a lot of lead in that, like the Google, Microsoft, and your OpenAI. All these are companies who have already taken some lead, but at the same time, there will be more to come. So the only here is to basically understand what AI is, what is leading to that AI, what are the component industry in this game, what are the processing industry in this game, and after that you will be able to decide that which are the players which are part of this industry, and hence you choose those players to be part of your investment portfolio. And but again, it is a very new area at this point of time, which is going to grow by around 20 to 22% CAGR over a period of next 7-8 years. But at the same time, you have to see that which are the sustainable companies who can sustain, navigate, and who have enough money to invest into the development of this technology over a period of time, because this will be a capital intensive activity. It is not easy to develop those kind of models and modules in a overnight situation. The adaptability would be strong, which will be little long drawn, and you need to have companies which have a long sightedness and capabilities to sustain themselves and give solutions around it. So again, component side and as well as processing side of it would be also be interesting to look at it. And the other side of to look at it is the kind of solutions they will provide to various services industries in the country, in any place, will be again the adaptive, who will be adopting the AI technology. They would be also be very attractive in terms of investments.
So, Anshul, my question therefore linked to this is that, you mentioned two, one or other, there are two trends that we could see. One is the AI and the other one is EV. Which are the other mega trends that you see over the next 5 to 10 years that would shape the globally as well as in this country? Which are the other ones that you
Yeah,
can
see,
see?
if you clearly have to see the pattern, it's very simple to see how the consumption and how the geography or economics is moving of any geography for that matter. So one of the interesting space when you look at it is the infrastructure space, where you look at specifically from the Indian perspective, when you look at a lot of infrastructure development which is still to happen. So that way and you can see from the government side of it also is a lot of capex happening. So logistics, if you're becoming a manufacturing hub, then logistics becomes a very important sector to look at it, because if you produce these kind of end goods, the logistics companies will transport these goods to the destination, so that industry will become good. The clean energy is one of the very important industries to look at, because that is has a global attention to it. Because globally we are looking at making sure that your global warming does not go up beyond 1% in the next 3 years. 1 degree centigrade basically, when you say 1%. Sorry, 1% is not the right word. 1 degree centigrade over a period of next 3 years. So clean energy would be one of the sectors which would be very exciting, and there will be a lot of global money which will flow into that from that perspective. So that is the space where I think which has come up. Another, as we say that once your technology usage will go up, so the data processing and the data providing industries, which is typically telecom, will also play a huge role over a period of time, because ultimately, if you look at even in India perspective, just 40 to 52% of the population is using data at this point of time through internet. So, and that too, it may not be a complete speed which is going to get what you're getting into a category A cities as compared to B and C. So I think a lot to happen on that side. So telecom would be a very attractive sector even to look at.
And from this, what advice really you would have for an optimal portfolio?
See, the portfolio, any portfolio, if you look at it, has to be reasonably diversified. So diversification is a one word which is very important in any portfolio. Now, diversification can be sector-wise. Diversification can be thematic, which is between a defensive and a non-defensive sector. When you say defensive, it is like an IT or a consumption sector, which is defensive, but non-defensive can be BFSI sector, which is automobile sector, which is dependent on certain factors. So diversification between that, diversification between geographies also nowadays becoming important, and you have tools to conveniently invest into various geographies. So that also becomes an important aspect when you diversify a portfolio. Then obviously stock diversification is critical, but yes, it should not, your stock portfolio itself should not become a mutual fund.
Right.
So there has to be a limitation to what kind of an concentration you can have onto various stocks. So I think these are the couple of diversifications which one should look at, and adding to it would be definitely gold and silver.
Right. And therefore, how should you hedge yourself against some of the things that are playing out again, which is inflation?
Right. So see, the inflation is both a good and a bad problem to have. It's a good problem to have actually. So because it signifies growth. So that way, from that perspective, I'll say again, the larger word is diversification. So if you are able to diversify between various asset classes, including commodities like gold and silver, and to some extent also real estate.
Right.
So that can also be a part of your portfolio to hedge against inflation. So I think if you can combine these judiciously, and another bigger important factor to get a really good value out of your portfolio is rebalancing it with time. Gone are the days when you say fill it, shut it, forget it for 20
Right.
years. You can't afford in this ever-changing environment today. So you have to make sure that you rebalance your portfolios at least once in a year.
Right.
And definitely an expert advice will add a lot of value, because they understand these business models and sectoral developments way too better
Right.
than what you have an information on.
Right. So the key, therefore, is to constantly rebalance.
Absolutely.
And not just do it. You're saying you should do it once every year at least. As a
That's
tendency.
bare minimum. That's bare minimum. If you are able to do it twice in a year, that's also
Right.
good.
Right. Okay, thanks. That was really very, very, insightful, Anshul. We will now open up the floor for any questions that we would have, and we'll wait for our first question. Okay, Anshul, we have the first question. Okay, I'm just reading that out. India is going into the general election in the next 6 months. As historical data suggests, markets are expected to remain volatile.
True.
Okay, how should one approach it during this time?
See, elections are temporary phenomena. They come every 5 years, right? As simple as that. And markets always are volatile in uncertain periods. Whether it is geopolitical uncertainty, whether it is any event-specific uncertainty, and obviously for in an Indian market, election is one of the biggest uncertainties which it brings on the table. So markets would remain volatile. The important thing would be to continue holding fundamentally strong stocks, and do not do too much activity in this election period. When because the markets are volatile, the important is to stay put in the market and stay with the market. This volatility will subside when the results are there, and we have seen returns coming from the markets over a period of time on the backdrop of strong policies of any government. And I'm sure any government which comes will be very, very pro development, because the path which we have already taken in the last 10 to 15 years. So short-term volatilities, you just have to stay put in a strong, fundamentally strong companies.
Okay. And now we have one more. Oh, yes, we have one more question. And the question, Anshul, is that on the global macroeconomic scenario, the US has hinted on an interest rate which is likely to stay on a higher side. Though you have the JP Morgan CEO, Jimmy, warning the world that the Fed is not prepared. The world is not prepared for the Fed. How do you think investors should prepare at this point?
See, as I said, what you need to be is remain invested into a fundamentally strong companies which has which have the models which are we have proven sustainability models which they have. So because ultimately money will follow the returns. And looking at even Fed maybe going up by another maybe 25 basis points or 50 basis points, ultimately it is the emerging markets which will give the kind of an required returns which are there, and that money will sooner or later will also, once the again I'll say volatility subsides in Fed, depending on where do you see the interest rates going either up or down, and once that volatility or speculation subsides on that side, ultimately money will follow where you get a returns higher to that. It will be difficult even for US to sustain those high level of interest rates over a long period of time. So I'm sure once as I said, once the volatility subsides, money will follow the returns.
So, Anshul, linked to that, to the question, I have a question, and that is that while it is fine that those who are invested should stay invested, what would you say to a new investor in this time?
See, to a new investor,
Who's just entering the market, and should they enter? Should they wait? Should they say 6 months away? How should they behave?
So no, one answer is, what is the right time to invest in markets?
Correct.
So the answer is very simple. A right time to invest in markets was either 20 years back or it is today. So there is no right time to enter. There's all times a right time to enter with a horizon of around 10 to 15 years of investments. So that's one advice to all investors: stay invested and invest. Even today, if you have money, you should invest. The only thing is you should invest as an informed decision. So study a bit, study the company where you are investing. If you can study, great. If you can do your own set of research, great. But if you cannot do that, take advice and follow the advice.
Right. Last question that we'll have time for, Anshul, and that is that, in the post-pandemic world, how important is the resilience on a portfolio? And what strategies do you recommend to build a resilient investment portfolio?
So resilience is a word which is very, very important in any portfolio. As I said during the conversation, I think the important part is invest into companies which has sustainability, which can sustain in diverse situations. So that is the one important thing which you have to look at the portfolio. While these strong, fundamentally strong companies with a large sustainability may not give as exciting returns as you want to look at it, where a company who can give you returns which are cyclical and are driven by cycles, but at the same time, if you have well diversified portfolio where and we can navigate through good cyclicals as well, but fundamentally strong and, as I said, defensive sectors, which is like IT or consumer staples, capital goods and all that, would definitely be more helpful if you want to be more conservative on your investment portfolio.
Right. I'm sorry, Anshul, but we have one more question. And the question is, what's your view on the recent IPOs? How do you look for good undervalued, assets that are there? How do you look at that?
So when and the markets are this exciting, so a lot of companies come and try to raise money and they become successful as well. All you need to look at it is good advice on that, because till the time you're not listed, the information is very limited available to the investor.
Right.
Because once you are listed, there are different norms and there are a lot of information which is available in the market. In an unlisted space, till the time you're not listed, you need to really look at the company details and fundamentals in deep details before taking a call to invest in that company through the IPO route. Because when the markets are euphoric, a lot of companies come in and some of them are really great, fundamentally very strong and backed up by very strong management. So they may be a really good investment at this point of time. But at the same time, you need to be really alert in choosing them well among the lot. So probably a good advisor can give you reasonably good advice which IPO to invest into and which IPO to refrain from for a short period of time, and wait for that company to really perform and give details, rather than just jumping the bandwagon and possibly investing in every IPO which comes.
On that note, I think we are done. And Anshul, thank you very much for giving us all your knowledge and insights. It's been an absolute privilege hosting you today. So thank you very much.
Thanks Arwa.
And thank you, everyone.
Thank you everyone.